Hi, my name is Stuart Weems, and welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. Okay, let's get into today's Q&A session. The first question is from Lucky. Of course, that's a pseudonym. Lucky writes, I'm an old client from over 10 years ago, back when I was a junior doctor using your firm's accounting services before you shifted to a more premium option. I still have the 2018 edition of your book attached. She has a photo there. I moved overseas interstate and recently discovered your podcast. So great to re-engage, and thank you so much, Lucky. Now in my early 40s and my wife is in her late 30s. We both work full-time. Current incomes after tax deductions are 300 plus 150. No kids, but planning to have one in the next 1 to 2 years. Lucky goes on to describe his financial position. Essentially got a primary place of residence in Melbourne in Brunswick West, worth about 1.9, essentially no debt, a home loans offset. A duplex townhouse in South Melbourne, also worth about 1.9, with about 40% in the offset, yielding 3.3%, which is pretty good yield. So it's getting close to positive cash flows and not a big negative cash flow there. Combined super of 700,000, all with UniSuper maxing out concessional contributions, and about 430,000 in ETFs/shares portfolio that he's accumulated in his name over the last 15 years. Lucky goes on to describe that he unfortunately suffered a medical illness 10 years ago in his early 30s. Can't get income protection insurance because of that pre-existing condition, and wasn't really sure, what his prognosis was post that illness. But thankfully, that's 10 years ago. He's in remission and fit and healthy, all those sorts of things. But because of the illness, he's said he's been a little bit more conservative than he would have otherwise been in terms of aggressively repaying debt and those sorts of things. But now his wife and he, as I said, expect to have a child in the next couple of years. Happy to work until their mid-60s if their health and mind allows them to do so. And essentially, he's got a couple of questions in terms of, when they have a kid, they might want to return back to Sydney, where his wife's aging parents are, and, so just be sort of closer to family. So the questions Lucky has is, given my health history, I was previously hesitant over gear. Should I reevaluate this going forward? It's a really interesting question because it sort of pulls in both directions. On one hand, you want to be a little bit more conservative because, if I pass away, I want my spouse to be looked after, of course, and don't want my spouse to be left with a lot of debt. On the flip side, if I have a sort of shorter runway, if you like, then arguably I need to be a bit more aggressive, because I'm not going to be around necessarily to earn an income to contribute towards that sort of future nest egg. So that's why it's not an easy answer here, because on one hand, yes, you should be more conservative with gearing. On the other hand, you should be more aggressive. Anyway, I might circle back to that. Like, he's asked, what should he do? Repay the Melbourne property to free up borrowing capacity so he can buy something in Sydney. Thinks he needs to spend around $2.5 to $3 million in Sydney, and maybe move into that in the future if and when they want to relocate back to Sydney. Should they make use of current low prices in Melbourne and upgrade the primary place of residence? Or should they continue to keep saving, investing in ETFs and super, and only buy a place in Sydney if and when we move back there? Or any other suggestions? And I guess the other observation I didn't share that Lucky made was that, over the last 5 years, both his investment property house haven't really changed very much in value. And we know, I've spoken ad nauseum about the fact that Melbourne market really hasn't moved. I think firstly, I'd be really concerned about making a really substantial financial decision without any real data to know whether that decision is going to be a correct one. So that is, well, I think I might be in Sydney. I don't really know how long I'm going to be in Sydney for, or whether I will be. So I'm going to spend $2.5 to $3 million on a property. I mean, that just to me feels too aggressive, because it might not work out, and entry and exit costs and holding costs and all those sorts of things. Also, repaying your home in Melbourne, you've got to be really careful about repaying debt as opposed opposed to offsetting debt, particularly if there's a chance that that property might become an investment property in the future, because once you repay the debt, it's gone forever, and then you've got an ungeared investment property potentially down the future. So you also want to be careful with that. Look, I think if there's a potential to relocate to Sydney, you haven't told me how old your wife's parents are, but essentially let's just assume there's some longevity there in terms of lifespan. I would probably be inclined to hold on to the Melbourne properties, go and rent in Sydney where I wanted to live, and just make sure this is something that you're going to do for the foreseeable future and there's some longevity to it. And the reason I say that, it's a little bit of market arbitrage, I guess. But, Sydney doesn't look undervalued or overvalued. It looks pretty fairly valued. If you look at those sort of longer term indicating sort of figures from a capital growth perspective, whereas Melbourne looks grossly undervalued. So I think you're probably, the risk of getting priced out in Sydney is always present, and I think there's a long-term risk of that. But in the short term, I think I would expect the Melbourne market to, over the next 5 years, to appreciate at a faster rate than the Sydney market in percentage terms. Now, of course, we're dealing with a much larger asset in Sydney, although, in Melbourne, we've got almost $4 million of property. So it's not too bad. We've got kind of like for like, if you like. So I don't think I'd buy a property in Sydney. I would rent and make sure that's really what I wanted to do before I put a substantial amount of my wealth towards that. I'd hold on to the Melbourne properties on the idea that over the next 5 years, we should start enjoying significant returns and probably better returns, hopefully, than what Sydney might get. And then when it came time to purchase in Sydney, I think the view that I would try and take, subject to borrowing capacity, is I'd take all the money out of the offsets in the Melbourne against the Melbourne properties, because obviously there'll be investments at that time. And then I will contribute all that cash towards buying the family home in Sydney. And I will make friends with carrying much higher levels of debt for, say, the next 5 years, whilst I'm enjoying the rest of the growth cycle of Melbourne, knowing that if we look at back in history, the median or average growth cycle lasts for about 10 years. And then I'd sell one of those properties in Melbourne after 5 years, so this is really in 10 years' time, to repay debt. So that would be my sort of debt exit strategy, if I like, to benefit and hold the Melbourne properties for another 10 years, buy in Sydney in 5 years' time, for instance, and then carry that higher debt. And in 10 years' time, hopefully, I've got very little debt. In terms of the priorities to put more in super and ETF investments, you're already off to a good head start there, and the compounding capital growth will start to kick in now. You've got 700 in super, 430 in investments outside of super, so 1.1, a little over $1.1 million. The returns will start to become more in dollar value than what your contributions are, and that will really start to compound. So it's not a key issue here in order to do that. If I thought that's the direction I was heading, I would just probably continue to accumulate more cash in offset accounts, so that when it comes time to buy in Sydney, you're borrowing less, which I wouldn't be ignoring making ETF investments, but I'd probably just wait. If there was some market volatility, I would do it. But given markets all-time highs, I'd probably just be happy to let those assets ride out and just accumulate more cash. So there you go, Lucky. That's what I think I would do in your situation. Of course, none of this is advice, really just looking at the pros and cons and really just writing out mostly the cycles in property market conditions. Okay, next question is from Matt. Matt writes, "Hi Stuart, thanks for the podcast. I really find it interesting. I often share with friends who are keen to learn about finance. Thanks so much, Matt, for sharing the podcast, and to everyone that shares the podcast. My wife and I are both teachers heading into our retirement soon. I have a basic financial planning diploma that I received about 15 years ago that I attained from simply having interest in investing. So that's really great. We plan to retire at 55. I've organised about $1 million in index funds for us to fund from age 55 to 60 before super kicks in, which should be around about $4 million by that time. We own our home outright, and I have 3 investment properties worth a little over $3 million. We'll be selling one of them to clear the majority of our debts. It sounds like, Matt, you're in an excellent position. You've done a lot of hard work and good investing over that period of time, so well done. After clearing the debt on our direct shares index funds, I'll be left with around $900,000. The remaining two investment properties have 850 owing, I think 850 in total. Rather than paying out their balances, I'm thinking about putting $500,000 in the offset account against one of them and putting 400,000 into index funds or making further non-concessional contributions into super. I could then stay fully invested in the share market for 30 years and use the offset account to manage market downturns. The two investment properties would be slightly positive cash flow and another hedge from the share market. They are low-yielding, high-growth homes near the beach, so they provide little income anyway. Interested in your thoughts about using the offset account to manage share market risk. I like that money is effectively earning what the loans cost us rather than in a savings account. Thanks, Matt. Look, it's a really great question, Matt, and it's a really good conceptual consideration on how do we view money in offset accounts. Because quite often our strategies will include, once the home loan is repaid, starting to build cash buffer in offset accounts, just as a bit of a safety net to also minimize interest costs, because obviously when we get into retirement, we don't necessarily want our property portfolios to be massively positive cash flow because, same in Matt's position, they tend to be low yielding, high growth properties anyway, so they're never going to be, but we don't want them to be taking money out of our pocket. And so our strategies tend to include some level of, accumulate savings in offset accounts. And the way that I would look at it, because the property will eventually become positive cash flow. Again, it's not necessarily going to eventually become a really big earner in terms of income. And the thing too, the insidious nature of property and taxation is that the land tax starts to mount up. So actually what you can kind of predict is the property's never really going to throw off a lot of income because of those things. But the longer you hold a property, it will eventually pay for itself. So it's then just about how you're financing the property rather than the property itself. And so the way that I look at it, and we look at it in our business, is that the cash in offset is a defensive investment. We're not looking at it as a permanent reduction to the loan. What we're looking at is saying, much like what Matt is looking at it like is it's cash that we're able to use and draw upon. And one of the downsides to property is its illiquid nature. So you can mitigate that illiquid nature by building liquidity in the offset account and doing exactly what Matt suggested. And what Matt is suggesting is that in that 5 years between 55 and 60, if the share market has a terrible year and he doesn't want to sell investments or the income's being lower or whatever it might be, he can always dip into the offset account to fund living expenses. And he might need to only do that for a few months. 6 months, could be a year, could be even 2 years, but it doesn't really matter. He's got time up his sleeve in order to do that. And then eventually when the market recovers, and 2 years would typically be more than enough. I think the GFC was down a little bit longer than that, but if you look at most of the market corrections, 2 years is more than enough. That's going to help him ride through that volatility. I like your thinking, Matt. I don't think I would do anything different if I was in your situation. And I like the fact that we're parking money in offset account for liquidity purposes, but also helps my properties pay for themselves. And I think, as I said, it's a common strategy we use commonly with clients, and it's a great way for property investors to start thinking about it. How much is enough? This is the other thing too, is you want some money in offset. You don't want too much money in offset. So I think if I was a property investor and all I did over the next 20 years is put money in offset accounts, I would argue, that might suit some people, but I would argue it's a less efficient approach. So it's about a balanced approach, but it's exactly what Matt has done because he's accumulated assets outside of super to fund early retirement and then the money in offset. Again, well done. Great outcomes, Matt. These questions are really good, I think, because I think it shows younger people what's possible. Now, we don't know what Matt has been earning, but he and his wife are both teachers, so we can kind of get a guess and we can kind of see what's possible by using an approach that's, some money in the share market, a lot of money in super, and then 3 geared investment properties. Okay, next question from Steve. It's a great question, in fact. Steve writes, I loved your episode 362, which was the 4 evidence-based golden rules with respect to property investing. It's a great summary of the factors to remember to succeed in property investment. I will recommend it to my sons. Fantastic, Steve. Thank you. I really enjoyed recording the episode. And, I think, and this is why I wrote Investopoly, the book, before this became the podcast, because I think that I have a strong belief that financial mistakes almost never occur because of random bad luck. And this is really important for people to understand. The mistakes that people make should be predictable from the outset because they aren't in line with basic fundamentals and the laws of basic math or logic or whatever it might be. And so the idea was write this book with these rules around investing, and then the idea is if you follow those rules, the chance of making a long-term mistake are greatly reduced. And that's what made me write that blog, that episode 362. Go back and have a listen to it if you haven't. If you're thinking about investing or you know someone that's thinking about investing in property, I think my strong belief, follow those 4 rules that I've outlined in that podcast. Your probability of success, I hope this doesn't sound arrogant, probability of success is greatly enhanced. Okay, Steve goes on to write, in the episode you talk about choosing a location with a strong history of growth. The problem I've always struggled with over the last few years is where to get that data, as I need to do my own research at a reasonably affordable price. I used to get suburban postcode series reports from Residex for $50. Unfortunately, they've been taken over by CoreLogic, which is now called Coality, I think. And then they tripled the price. CoreLogic tripled the price. Wow. I could get Capital City stratified mean series from the ABS, now discontinued and replaced with an inferior unstratified mean price series. It seems like access to property data is now only available to companies and the very rich. Could you suggest anywhere that I can get quality postcode or suburb or regional price series at a price that's affordable to the average investor, not thousands of dollars? Appreciate any suggestions. Steve, this is an excellent question. Back in August 2020, and I didn't have episode numbers at that stage. That was a bad lack of foresight there by me. But if you Google Pro Solution, property data is not always right or helpful, it'll take you to a blog, and you'll be able to find the same podcast if you probably Google Apple Investopoly property data is not always right or useful. Anyway, that's the name of the episode that I wrote coming on 5 years ago now, or probably more than 5 years ago now, because it's going to relate to my answer. The problem is if I pick postcode, that the problem with those old Residex reports is that it does look at median house prices or median apartment prices at a postcode level. And you can find the data even at a council level as well. But the problem is, I'm not really comparing apples with apples. And I would argue that data has less applicability to making investment decisions. In fact, putting it a different way, I would caution people against making really important financial decisions based on that data, because all we're looking at in a suburb median value perspective is the transactions that occurred in one quarter, and the median house price is really just the midpoint of all those transactions. So it really depends on how many transactions occurred, what was the market doing at that particular time. So for example, in really soft markets, typically the people that hold really good quality properties, so if you know a street that's relatively tightly held and it's a really sought after street in a particular suburb, chances are in a subdued market, a softer market, very few people sell those properties. But in a buoyant market, there's more transactions. So you need to then consider, well, what happened during that particular quarter? What types of properties sold? If we look back to, this is a long dated example, but back in 07, I think it was Kevin Rudd that doubled the first homeowners grant. Well, in certain suburbs, when you looked at, say, dwelling sales, more apartments sold in that particular quarter because there were more first home buyers, and that kind of skewed the results at that time as well. So I don't really like suburb data. I don't even really like median house price data. I mean, I talk about it in the podcast. It's a good indicator of what the general market is doing. Okay, so what can you do then? Well, the good thing is there's probably a lot of free data already out there. But what I would want to do is, if I'm considering buying, let's say, a 2-bedroom Victorian cottage on 150, 200 square meters of land in Hawthorne in Melbourne, let's say that's what I'm considering that type of asset, then what I want to do is, and if I see that 13 Smith Street is for sale, for example, well, what I'll do is I'll trawl the internet and find out, what is 15 Smith Street sold for? What is it it worth today, do I think? And what are the transactions of 15 Smith Street, which is next door? And then I'd look at 11 Smith Street, which is the other side. And as long as those two properties were comparable, and normally if we're talking about Victorian cottages, normally in Hawthorn, you'll have a full street of Victorian cottages, if not one side, if not both sides. And there's a lot of comparable data. And now you've got to make sure, was one renovated? Did someone put a third bedroom at the top at the rear, or those sorts of things? But that's where you're going to build your data set from. And so you can then expand down that street to build your data set, and then adjoining streets if they're of similar sort of nature and quality and amenity and so forth. And that's what I talk about when I'm talking about evidence, because what you're doing then is comparing like with like. You're trying to find a property that's comparable to the one that either you own or that you hope to own in the future in terms of a new investment, and then work out, if I had have owned that property over the last 30 years, what would have the results been? Now, I know on Domain and realestate.com.au, quite often they will give you that past sales history. And so what you can do is have a look at what is the oldest sale, and hopefully you want to build like a very longitudinal data set. So hopefully you can see a sale there in the 80s, and maybe it sold in 2010s or something like that, and you can then calculate an implied capital growth rate over that time. Again, you've got to be conscious if there's been any changes or renovations to the property, but you can kind of adjust with that in your calculations as well. So even if ResiDex still sold those reports, Steve, I would still say to you, I wouldn't bother using them. Build your own data set, understand how properties behave in certain locations, and then you can get a little bit of an idea. You can use this approach in other locations, other non-investment grade locations as well. So it is possible, although we subscribe to RP Data, so we've got that data series, if you like. It's a little bit easier for us, but it is possible, if you crawl around on the internet, to be able to see in a particular location, hey, well, I can see where the growth trajectory's been. So you might look at a location and go, okay, prices did nothing for many years or decades, and then it had a really strong spurt, maybe because there was some infrastructure built or something happened, and then there hasn't been any growth since. Because I think that's really important also. What you want to do is, how consistent has the growth been relative to market conditions? So you want to look at, what did the median price do over that time, and what did this property in these locations do over that time? And you want to see that if it's investment grade, that it's outperformed the general market conditions. Now, if the general market conditions have been flat and the target properties you're looking at have grown at 3%, well, that's still outperforming in relative terms. But the whole thing is, you want to see, very long data over 20, 30, 40 years, and you want to be convinced, you want the data to convince you that properties in that location have performed really well. Now, if you're looking in Melbourne, for instance, you're probably better off to focus on periods that exclude the last decade, because we know over the last decade, it's been really poor performance. But that's why I say you've got to look at relative performance, as in relative to the general market conditions. But great question, Steve, because I do talk about, looking at that historic growth. And the important thing that I missed is, how to get that reliable data. Okay, next question. I say this every time. It's a good one. So this question is from Jordan. I'm going to try and summarize as much as possible. Jordan is 25. His girlfriend are 24. So very young. Combined income's around $200,000, and they generate around about $80,000 in rental income, I think, gross rental income. They've got two properties, and Jordan speaks about they've saved, sacrificed, and killed themselves to buy these two properties. Bought an apartment in 22 in Brisbane, and it's done really well since they purchased it. I mean, they would have timed the market perfectly. So looks pretty close to an investment grade apartment for me, and the apartment market has kicked off since 22, so perfect timing. I guess that timing the cycles, or being considerate of market cycles and buying investment grade, certainly works, and well done to Jordan for that. And then he's bought a 3-bedroom home on 300 square meters in Kew in Melbourne for 1.5 million. I don't know what he paid for the apartment actually, but there's obviously a bit of growth in there. Oh, there you go. Just over $500,000. It's now worth 770. So off to the races only after 3 years. And the place in Kew, I had a look at it. Jordan asked me what my opinion is. My opinion is I think it's an excellent asset. Anyway, their goal is that once the Melbourne property grows, maybe they'll sell the apartment and buy a investment grade house in Brisbane and then rent that out until that such time that they start having a family and they then occupy it as their family home. But they're kind of sick and tired of killing themselves, rent vesting, doing all those sorts of things. They want to have a little bit more balance, upgrade the car a little bit, go on a couple of holidays, those sorts of things. You're young, you're only in your 20s once, so you definitely want to enjoy it, Jordan. But they're worried about, borrowing capacity, being able to do that. Maybe they should then keep investing, maybe in the share market, additional super contributions, those sorts of ideas. And they've asked my opinion. So I think they've timed really well. Clearly, in hindsight, timed the Brisbane market perfectly well. They've got a good quality asset there that I think will continue to perform or provide above average capital growth for the next period of time, potentially right through to the Olympics 2032, so another 7 years potentially. The Melbourne property, it looks like they've done really well with that as well in terms of locality and type of asset, and also looking at its historic growth rate. So really congratulations, you're both in mid-20s. You really have made two really, to my mind, fantastic decisions into investment decisions. And I think those investment decisions are really going to put you in a super strong position. So well done. A little bit of delayed, or probably a lot of delayed gratification there. Living at home, scrimping and saving, driving a car, apparently a car with 430,000 kilometers on the clock. So, there's some sacrifice there, and well done. No, I don't think you've seen or reaped the benefits yet of all those hard work and those good decisions, but I'm positive you will over the next 5 to 10 years. Look, with property, and I'm going to contradict, sometimes what I say in this podcast, with property, all you can really do is put yourself in the strongest position, make some really good long-term decisions, and then it's really difficult to plan how it might pan out, because distribution of returns and timing of returns can make a big difference. So that can be a real challenge. But all you can do is just make the best quality decision that you can make and then hope for the best, which I know is a kind of a stupid thing to say for a financial advisor because hope's not a strategy. But the way I would look at it in your situation is that you've geared heavily, and so you should, because you're in mid-20s, and it's still affordable. You bought two really great quality assets at the right time of the market. Now, we don't know how Melbourne's going to pan out, but my guess is it's the right time of the market. You've done all the work now. Now it's the time for it's the market's turn to do all the heavy lifting. So I would worry about it too much, which is to say I wouldn't necessarily set in stone what the plan looks like. The approach that I would take is I'd say I've got these two great assets. I'm going to monitor the market. I'm going to monitor their performance relative to the market, which is difficult to do in a real-time basis. It's not like every year you can measure what has the market done, was my property done. It's not as perfect as that, but you just want to know that if the Melbourne market is moving, you want to see that houses or properties around similar to yours are moving as well, and then just see how it goes. Now, I think, in terms of you being priced out of the Brisbane market, or you being at a disadvantage because you've invested so heavily already in these two assets, I think is a very small probability, or a very low risk, if you like. I wouldn't be worried about it. I think apartments, particularly in percentage terms, will outgrow houses over the next period of time, because they're a little bit later, in terms of its growth cycle. I mean, houses started to grow about 5 years before apartments did. So houses are deeper into the cycle. I've also spoken about how I think the Brisbane market will still enjoy a lot of positive sentiment around the Olympics, and the relative value of apartments, and this is true in Melbourne as well, relative value of apartments to houses. Apartments look like really good value, when you compare that relative value, particularly if you don't want to compromise on location. So, the more houses cost, the more people are sort of pushed into that market, is kind of what I'm saying. So for that reason, I think the apartment will continue to grow. I think you've bought really well in Melbourne. I think that will continue to grow. And then what you need to do is work out, okay, when do you want to get into that Brisbane market and flick the switch on that? But you don't want to do that too early, right? Because you want to enjoy the full growth cycle, is what I think. And also, because you're young, you're able to take on more debt. So if it means that you hold on to these assets for a little bit longer, even though your entry price is better, as long as you're net better off because you've got these two assets, that's all you need to really worry about. So I wouldn't do anything. You've done well. take a breather now, get a bit more balance back into your life in terms of holidays, upgrade the car, do all those sorts of things, and just monitor it and see how those markets play out. Naturally, I'll be talking about them and talking about, where I think those markets are going to go. And I also think that, even if the Brisbane market does run up until 2032, I think it'll go through a flat cycle. So I'm not even sure that, the timing around these sorts of things is going to be that critical. Maybe the timing will be more driven by your personal circumstances, not so much necessarily the market. But I think if you held on to the apartment for another 5 years, for instance, sold it and then got into a Brisbane property, I think in hindsight, it's going to work out really well for you in order to do that. That's not hindsight, is it? That's foresight. My bad. Okay, the second part of Jordan's question is, how do you balance the competing objective of producing the largest return in dollar value versus your client's desire to spend money on non-financial things like holidays and cars? To celebrate buying our second investment property, we plan to go to Italy next year for about a month. I'm finding it difficult to justify spending $15,000, $20,000 on holiday when that money could be saved or invested instead. I can rationalize what we're doing well, and that a holiday would not be a waste of money. But after spending so much time focusing on saving, it feels like investing the money would be better use for us. I did a podcast about this around change of mindset, and you've just got to be really careful about this change of mindset, because sometimes people get used to saving and investing aggressively, and then they don't end up changing. They adopt that mindset for the rest of their life. And that's fine. It's not my life, and it's not for me to say that that's the wrong approach. But what I like to do is, my approach is got to be balanced to my mind. If I'm going to sacrifice and do what Jordan has done, there's got to be some icing on the cake. There's got to be some reward there. Plus also, Jordan, you don't know, you're very young, mid-20s. You don't really know how long you're going to be left on this planet. Wealth building is really very much a journey rather than a destination, and you really want to enjoy that journey. So if you were my client, I would certainly encourage you. You're in your 20s, my God, definitely go and travel. Life's too short. You definitely have to do that, in my view. Now, I remember reading something about Warren Buffett in terms of upgrading his couch. It's a long, long time ago. And he worked out, he told his wife, compounding interest, this is how much the couch is really going to cost me, because if I put this into an index fund and held it for 50 years and et cetera, et cetera. Look, whatever floats your boat, I get the math behind it. But I would say, compared to probably most other 25-year-olds I've come across, are miles ahead already, right? So recognize that you've made some really smart decisions, and you're really on track to being, by the time you keep doing this, by the time you're in mid-30s, you're going to be miles in front of most people in their 30s. I think you can afford to spend 15, 20 grand on a holiday. And also the final thought I will leave you with is that cash flow management is the critical element here. So clearly you're really good at saving. If you're really good at saving, that's the answer to your future success, because you're always going to be able to make those prudent decisions. You're always going to make friends with delayed gratification, and they're the necessary ingredients for long-term financial success. So I wouldn't worry about it, Jordan. Congratulations on everything that you have achieved to date. Good luck for the future, and have a fantastic holiday in Italy. I'm conscious of time, gone way over today. Look forward to joining you again tomorrow, of course, where I'm going to do a deep dive into long-term property data and sort of pull it apart and talk about where property markets are at, which will be probably good or complement the answers that I've given Jordan and Steve today. Okay, that's it for me. Until tomorrow, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.